Hello, everybody. Got about another minute here. I kind of rearrange things a little bit. Let's do this. All right. Okay, so just real quick, some students have started asking about preparing for the final exam, and just so you know, there's already out there on YouTube, and there's a link on the Canvas page where I have it's like a two-part lecture. It's called like comprehensive review or something like that, and it's really meant to offer a sort of a launching point as you prepare for the final exam. It's certainly not the only thing that you should do to study, but it definitely just kind of gets everything going again. And so just to kind of refresh, chapter 13 and 14, some of those early chapters especially. But it's a good, I would kind of start there. So I think this test is on Tuesday, and maybe Wednesday or Thursday, go through that recorded session on Canvas. Go to the link, and that'll kind of get you going. And then I'll be providing more guidance as far as how to prepare for the final exam after this test is over. But I just wanted to mention that just because some students are starting to ask, and I wanted to give you a little bit of information. So today, chapter 22, for those that have kind of gone through the online lecture already, and I hope most, if not all of you have, it is a challenge. And so I think the hardest part about chapter 22 is it requires imagination. It requires you to kind of visualize what journal entries might have looked like and what mistakes might have been made and sort of where that would show up. And really there's kind of two parts to this that you have to understand. One is the journal entry part, and then the other part is the financial statement part. And so I have two problems that relate to journal entries today, two problems that relate to the financial statements, and they're very similar to the ones that you might see on a test. So this is going to be good practice, but at the same time, there's a lot of different mistakes that can be made, or errors that can be made, or misstatements that can be made. And so just be aware that just because it's not like these are the only examples, but it's meant to just sort of get you thinking about, okay, when I have a situation, what is the process that I need to do? And so there's no one way to solve these. And in fact, even in the earlier session today, I kind of started down more of a shortcut way to do it, and the students were struggling a little bit, so I kind of went back to a longer way to do it. And so we're going to do that longer way today in this session, and hopefully that helps, but we'll see. So a company, a 49er company, retires 100 5-year bonds at 101 on January 1st 2020. Each one has a $1,000 par value. The company used the straight line method to amortize the bond discount. And the bonds were originally issued on January 1st 2018, and they're issued at 99. On January 15th 2021, so kind of a year later, 49er Company discovers that it had failed to include the discount balance when recording the retirement. So provide any necessary journal entry information for January 15th 2021 to correct the error. In this case, we can ignore any tax effects. All right, so ultimately, for this kind of problem, I'm just going to give you some account names, and you need to provide, the entry amount, whether it's a debit or a credit, or of course, if there is no entry for that account, you do 0 and NA. So ultimately, this is just about getting to the journal entry. But what I found in the first class was that they weren't able to make that leap right away. And so what we're going to first do is sort of think about when this retirement took place on January 1st, 2020, what did the journal entry actually look like? And so the original journal entry would have looked something like this. So the journal entry that they had recorded, and if I could get the whole thing, they would have had the bond payable come off of their books. They would have paid the 101 for cash. There's no accrued interest, so we don't have to worry about that. And so the difference between the two would be the loss. This is what they did record. However, there's an important piece of information that's missing. And that important piece of information that's missing is this discount, because it says that it failed to include the discount balance when recording the retirement. So this journal entry is what they actually did. There's a problem though, because they're missing the discount. And so the sort of ought to journal entry, and we're not going to get all the numbers right now. So what should they have recorded? So they'd have the bonds payable, that wouldn't change. Let me see if I can find the right row. No, it's not what I wanted to do. Oh, goodness gracious. I don't want to see that yet. Sorry, give me a second. All right, there we go. This is what I want. All right. So they would have recorded the bonds payable, the cash, a loss, of course, and some sort of entry to the discount. And that's what's missing. So notice that in the original journal entry, they didn't have an entry amount for the discount, but they should have. And so what we're trying to do is to reconcile what they did up here with what they should have done, and then record any corrections to any accounts that may still have some sort of incorrect balance in their books, so that they can move forward with correct account balances. And so, ultimately, this is going to be discovered on January 15th, 2021. And there's going to be some journal entries, but we're going to kind of go to some calculations first. So in other words, this is all really about what happened with this discount journal entry. What do we do with that? And the first thing we've got to do is figure out, okay, well, what had they been doing with this discount over time? Well, the original balance would have been the $10 per bond. And the reason we know it would have been $10 per bond is because they were issued at 99. 1% of $1,000 is $10. And so each bond has a $10 discount, and there are 100 of them. So 10 times 100 is $1,000. There's a $1,000 discount balance when these are originally issued. And we're told they use the straight line method to amortize, which means that they're going to amortize. Again, it's a 5-year bond. They're going to amortize in total $200 per year. That just would have been what they would have done. And so given they were issued at the beginning of 2018, they would have had the amortization recorded in 2018, and they would have had the amortization recorded in 2019 for a total of $400, which means that the balance in the discount at the time of the retirement on January 1st, 2020 would have been $600. And hopefully that's, again, originally 1,000, 2 years of amortization means that 60% of the account balance is left, which would be $600. And so when we go to this, what should they have recorded? They should have taken the discount off of their books. That's what they should have done, right? So in other words, at the time of the sale, they would have needed to get rid of the remaining balance. In other words, they would have been missing, or they needed to credit the discount balance by $600. That's the journal entry that they should have recorded, but they did not. And again, if they had recorded it correctly, then the loss on retirement, instead of being $1,000, would have been $1,600 because of the credit to the $600 discount. Is everyone kind of following sort of what the journal entry should have looked like compared to what it actually looked like? Is everyone kind of seeing that? Okay. Again, stop me if you have any questions. All right, so what do we do then? So we have this credit to the discount. So you can see, hopefully, that we needed to include this journal entry. We did not. Someone asked how we got the 600. So the original balance would have been $1,000, $10 per bond times 100. We recorded 2 years of amortization, one in 2018 and another year in 2019. And so the total reduction over that 2 years would have been 400. So 1,000 minus 400 is where we get the $600 balance at the time of this sale. at the time of the sale. Again, we're looking at the time of the sale. And so again, we have this $600 balance that's sitting there. It should have been recorded, but was not. And so in order to correct our accounts, we need to record a credit to the discount in the amount of $600. So then we got to think about what's the other part of that. Well, we can see that the loss on retirement was recorded at 1,000. It should have been recorded at 1,600. So that's basically there's the other part of the mistake. All right, that showed up somewhere else. So how do we think about that? So we know that the discount would have resulted in a larger loss, but this is important. The loss had been closed to retained earnings. So in other words, as soon as this sale takes place at the end of the year, December 31st or whatever, that would have been closed. It would have been closed to retained earnings. So in other words, there's no balance in that loss on retirement account. It's been closed to retained earnings. And so what that means is the offsetting part of the journal entry, the account that needs corrected is retained earnings. The loss is closed. It's zero balance, and it should be zero balance. There's nothing wrong there. However, retained earnings needs to be adjusted downward for an additional $600. That's why we're going to be debiting that account. I think that was all the explanation that yeah. Okay. So again, conceptually thinking through what actually happened compared to what should have happened. You don't have to do this on a test. This is just a tool to help you understand. As a practical matter, really what the only thing you need is the journal entry. That's what you need is the journal entry. But I hope by seeing the actual journal entry compared to what the journal entry should have been, you can see why our correcting journal entry is a debit to retained earnings for 600 and a credit to the discount for 600. Again, I'm going to stop there in case anybody has any questions. Okay. Now let's move on to the next one. All right. 49er Company acquires equity securities for $1,000 on April 1st, 2020. On December 31st, 2020, 49er Company reported the net balance of the securities as $1,100. On March 1st, 2021, they discovered that they actually should have reported a balance of $850. So clearly they made a mistake with what they reported as the balance. So we need to provide any necessary journal entry information on March 1st, 2021 to correct the error. Now, as soon as you see assuming that 49er's tax rate is 40%, it means, let's compare that to what it said up above. Here it said ignore any tax effects. Here it says assuming there's a tax rate. So in other words, we cannot ignore the tax effects here. And so just understand, anytime there's an error in the way we record revenue or expenses, there is the potential that that error could create a tax effect. It doesn't always, but it could. In this particular case, it does. And I'm going to show you why it does as we work through the problem. But that's part of the challenge with Chapter 22 is you have to understand how the accounting is handled under US GAAP, and at least on a simplistic level, how that compares to what the Internal Revenue Code does. And so kind of a similar process that we did before. I'm going to start with sort of what they did record, if I can capture it. All right. So what did they actually report? So if you think about it, they said, oh, the fair value is $1,100. And so what they would do is they would debit the fair value adjustment account $100. Since it's an equity security and it's passive, it's very small. Then in that case, there would be an unrealized holding gain or loss dash income. So this is that net income account. It would be credited for $100. So this is what they actually recorded as an adjusting entry on 12/31/2020. But what should they have reported? Well, they should have reported, if you notice, the fair value actually should have been $850. And so instead of having a debit to the fair value adjustment account, they should have had a credit of $150. And instead of having a gain on the income statement, they should have had a loss of $150. And so there's a fairly significant error, and you can see that that error even flips the balance in the fair value adjustment account from a debit balance to a credit balance. All right, can everyone kind of see that we have the actual journal entry compared to what we should have had? Does everyone kind of see that? Okay, now the second piece of this is the tax effect. And that is where it gets a little more complicated because I don't give you any income tax information. Notice that I don't have income taxes payable or income tax expense or anything like that. And the only thing you have to do is sort of imagine like, okay, what would this have looked like? And so these next two journal entries really aren't real. They're just a way to imagine the effect. All right. And so all right, so let's kind of look at this, what they actually may have recorded. Actually, let me do this. I know what I'm going to do. So hold on one second. Just turn off your, don't analyze what I'm about to do quite yet. All right, I'm actually changing something. I just realized a better way to do this. All right. All right, here's what we're going to do. We're going to isolate the effect of this fair value adjustment. And so if you notice that with a fair value adjustment, all right, so both when it's acquired under the Internal Revenue Code and US GAAP, they're originally recorded at $1,000. At the end of the fiscal year on December 31st, 2020, the company increases the value of that security through the fair value adjustment by $100. Anytime there is a disconnect between the book value under the Internal Revenue Code and the book value under US GAAP, if that difference is temporary, then you're going to have a deferred tax liability or a deferred tax asset. In this case, it is temporary because eventually I'm going to get rid of this thing and it'll all get reconciled. All right. But how do we handle that? So there's a $100 difference. And so you have to kind of reimagine the journal entry when we have these tax effects. Well, first of all, you can see, hopefully, that the fair value or the value on the books under US GAAP is more than it is under the Internal Revenue Code, which means we have a deferred tax liability. That deferred tax liability is the income effect, which is $100, multiplied by the tax rate, which is 40%. So the DTL is going to be a $40 credit. And so the offsetting effect is a debit to the income tax expense. So whether my income tax payable is $100,000, $1,000,000, or a gazillion dollars, there's going to be a $40 difference between the income tax payable and the income tax expense of $40 because of this DTL. So this DTL creates a debit to the income tax expense of $40. That's what they actually reported. Again, turn it off your analysis here for a second because I'm going to do this same idea, getting rid of that altogether. And then this becomes, oops, let me undo that. This one's going to be a little bit harder. Give me 1 second. All right. Now you can think about what I'm doing. All right. But what should they have done? Well, it should have been a case where, again, Internal Revenue Code, US GAAP, where all of a sudden now the value in that asset dropped. So the US GAAP book value is less than the Internal Revenue Code. So that's actually a deferred tax asset. And again, you take the income effect and you multiply it by the tax rate. And that tax rate is 40%. And so the tax effect is $60. So we should have debited a DTA $60, and that the offsetting effect on the income tax expense is a $60 credit. So there's kind of this income tax benefit from this DTA, right? So instead of having the income tax expense of 40, we should have really had an income tax benefit of 60. Again, this is comparing what we actually did to what we should have done. And that's the whole idea behind this. All right. So we're just kind of now, we have to take all this information and kind of say, okay, given these mistakes or given the difference between what we actually did and what we should have done, what sort of journal entry should we have to kind of reconcile everything that's going on? First of all, you can see there's there's several accounts. The fair value adjustment account is off. This unrealized holding gain or loss income, that number was wrong. Got to think about that number, but it was wrong. The income tax expense was wrong. there's a DTL and we should have had a DTA. So there's so much going on with this problem that we've got to kind of create a framework to work ourselves through it. And that's what we're going to do next. And so again, taking this actual compared to should, and then trying to work through a journal entry to reconcile all that. That's the challenge of this problem. Let's see if I can find the date. All right. So when did I discover this mistake? I discovered this mistake on March 1st, 2021. That's when we figured out that we had this mistake. Now, whenever we have a tax rate that we need to consider, there's three things or sort of three ideas that need to be kind of churning in the back of your mind, right? One is there is a full effect, the full effect of the mistake. There's the tax effect from the mistake, and there's the after tax effect from the mistake. All three of the things you have to say, okay, there's the full effect, there's the tax effect, and there's the after tax effect. We're going to kind of march through each of those next. I think this is what I want. Sorry. This is the problem with this approach, that they don't always know. Is it there? Nope. It's killing me. All right. There it is. I found it. Huh. All right, calculations. Here we go. All right, so back to what we did before, right? We're kind of taking this information and putting it into sort of a way to distill it. So what we actually reported for the fair value adjustment entry, we did a $100 debit. That's what we actually did. We should have reported a $150 credit. Again, that's what we should have done. Taking all that information, that means there is a correcting entry. We need to go from a $100 debit to a $150 credit. The only way we can do that is through a $250 credit to our fair value adjustment account. That is the full effect. The asset has the full effect of this mistake. So there needs to be a credit to our fair value adjustment account. Let's see if I can find the right one. I probably won't, but I'll try. Hey, there we go. I got it. All right. So we need to credit the fair value adjustment account by $250. That is part of this correction that we need to make. That's the full effect. All right. Now I had a page break here that I got to deal with. Actually, let me do it this way. Might be a little easier to see if we do it this way. Okay. So the next piece is the DTL DTA. Okay. So what did we actually report? We actually reported a DTL, a $40 credit. Again, going back up to here, this is what we had reported, a $40 credit to a DTL. We should have reported a DTA of $60. So we should have had a debit to a DTA of $60. That's what we should have done. So to correct this, what do we need to do? So the correcting entries, this is the tax effect. So the DTL, DTA, this captures the tax effect. The fair value adjustment is the full effect. The DTL, DTA is the tax effect. So with that, we need to debit our DTA for $60. At the same time, though, we need to debit the DTL for $40. In other words, we have to get rid of this $40 credit, and we need to create a $60 debit. So again, the $60 debit to the DTA and a $40 debit to the DTL to get rid of the incorrect balance in that account. So there are two journal entries for the DTA, DTL for the tax effect. And so when we put those together, we can see the DTA 60, DTL 40. Again, to correct the mistake that we made. Finally, with retained earnings, right? What did we actually report? We had an unrealized holding gain of $100. We also had an income tax of 40. So in other words, both of these accounts, this unrealized holding gain of 100 and the effect on the income tax expense of 40, together, they would get closed to retained earnings. So in other words, the effect really isn't in these accounts anymore because they've been closed. Their balance is zero and they should be zero. So there's nothing wrong with these two accounts, but there is an error in retained earnings. and the net effect of that error, the net effect on the retained earnings. So what they actually reported was a net effect of $60 credit to retained earnings. That's the net effect to this account. Okay. Second piece then, what should they have reported? They should have reported an unrealized holding gain of $150. They should have reported this income tax benefit of $60. That's what they should have reported. So the actual net effect on retained earnings should have been a $90 debit. That's what they should have reported. So how do we reconcile that? So the correcting entry would be a $150 debit to retained earnings. Again, we're going from a $60 credit to a $90 debit. And this is the after tax effect. So the fair value adjustment is the full effect. The DTL DTA is the tax effect. And the retained earnings is the after tax effect. And that would complete our journal entry. $150 debit to retained earnings. Again, the way that you do this is up to you. There's no one way to do it. I'm just providing these journal entries so you can kind of see how everything maps. But ultimately, when I'm solving this problem, this is where I focus. I'm just doing these calculations. But I'm going to stop there because this is the challenge. This is probably the most challenging problem on this next test. And I want to make sure that I give you an opportunity to ask a question. No questions? All right. I'm moving on. All right. Now, these next ones do get easier. So what we just did on the first two problems was the journal entry. And I think the journal entry requires a lot of imaginations because you kind of have to, you're sort of like trying to visualize all these different journal entries and how all that would show up. And so that's a challenge for sure. And this type of problem, we're really focused on given a correction in this journal entry to correct the mistake. What would that, or how would that show up on our financial statement? So in other words, whenever you have a mistake or an error, or even a change in accounting principle, you have to provide restated financial statements for any years that were affected. And so in this case, that's what we have to do is this problem is saying, okay, given this mistake, given this correction, what should we report as the restated amounts for each of this group of accounts? I don't have individual accounts for all of them. Sometimes I'll just kind of group things together just to allow it to be a little easier to process. And so on 12/31/2020, this is what we had originally reported. Now we made a mistake with this receivable. We should have accrued some sales revenue. We missed it. We discovered this mistake on March 1st, 2021. And so now we've got to go back and restate what we had originally reported in the prior year. And so let's start with each one. So in the chat, or you can unmute yourself, whatever you want to do. What should we report as the restated total revenues given this mistake? What should we have reported as total revenues? And if it's the same, that's an okay answer too. If it should have been 25,000, then 25,000 is the answer. If it should be something different, then what is that different amount? Now, in this case, we are ignoring tax effects. So we don't have to worry about full effect, tax effect, after tax effect. So we have somebody saying 25,800, somebody else saying that should stay the same. Somebody else agreeing with the 25,800. Anyone else want to chime in? All right, so on the count of three, you're going to choose 25,000 or you're going to choose 25,800. One of those is correct. So in your own mind, on the count of three, 1, 2, 3. And the answer is 25,800. 25,800. Good. All right. So the answer is because this receivable, if you can, again, think about that. Well, if I had a receivable, if I had recorded that receivable, there needs to be a credit, and that credit would have been sales revenue. And of course, that would increase what we would have reported on our financial statements as sales revenue. So the answer is 25,800. How about total expenses? What would be the restated amount for total expenses? Again, given this mistake, so Sailor says it should stay the same. Aaron agrees. Matt agrees. Somebody else agrees privately. I don't know if she realizes she's sending that directly to me. That's good. All right. And the answer is stays the same. Good. Next one. Same deal. Total assets. What should be reported, or what is the restated amount? And again, if it's the same, that's fine. Okay. So a little bit of disagreement. There is a bit of a consensus that we should increase total assets by 800. Somebody caught himself. Good, good, good. Yeah, the majority has it. Again, this receivable should have been reported on the balance sheet. It was not, which means that our total assets should have increased by $800. How about total liabilities? So Alexis, yep. People are saying same, same, same. Yep, it stays the same. Good. And then finally, total equity. Yep. Good. Good job. Yes, 80,800. Now, I think most students concur that this is way easier than the journal entries, right? And it's true, it is. And so, the goal would be that this type of problem you would do very well on, and some of you might struggle with the journal entry. And so it's a mixture. So if you don't get the journal entry problem completely correct, you're not gonna fail the test. All right. Now to get an A, you need to be able to do well on the journal entry problems as well. That's for sure. But I want you to understand there's a mixture of chapter 22 kind of problems where some of them are challenging like that, and some of them are a little easier like this one. All right. So it's definitely a mixture. All right, good job. All right, next one. Now, similar in format in that we're taking what was reported and we need to provide the restated amounts. The challenge here is that we are including tax effects. So we do not ignore any tax effects. We're including them in this case. And so, we had some accrued salaries expense. They forgot, they missed it. They should have reported it. They didn't. And then they discover it and they're like, okay, shoot, we need to fix this. And this is the way that they fixed it. This is the correct journal entry. And so now we have to take this correct journal entry and we've got to figure out, okay, how would that show up in our restated financial statements? And so let's start with our total revenues. What would we report as our restated total revenues given this mistake? So someone said 24,480. Someone says no change. One of them is right. So on the count of three, either in the chat or in your own mind. Oh, we're getting some consensus. Yep. 1, 2, 3. And the answer is no change. So salaries payable, think about that. If I have salaries payable, what's that going to translate to? Salaries expense, right? That doesn't affect revenue in any way. And then if you think about the tax effect, well, that's going to show up as income tax expense, which is also not a revenue account. And so really there's no direct effect on any kind of revenue account. And so our total revenues stay exactly the same. How about our other expenses? Again, same deal. If you feel comfortable, type it in. what should be our restated other expenses? Notice I have income tax expenses separate. So this would be any other expense. Is there any other expense that would be affected by this? Yeah, we're getting a strong consensus here. Good. Yeah, it would be 18,800. Very, very good. Yeah, because that salaries payable would have an additional salaries expense of 800, which means our restated salaries or restated other expenses in total would be $18,800. Good job. Now, this is the one where the students typically struggle the most. All right. What would be the restated income tax expense? And by the way, if you see a journal entry to the deferred tax asset, I'm going to tell you right now, the income tax expense is going to change. The challenge is in what direction and in what amount. So income tax expense. Right? It's a challenge, right? I've got so 3 different answers out of 4. Okay, starting to gain some momentum. Starting to gain some momentum. And that is true. It would be 1,720. Again, if you kind of imagine that DTA as a debit, there'd be some sort of benefit on the income tax expense because you'd have that credit. So it would reduce the income tax expense by that $280. All right. Again, trying to imagine that journal entry and figuring out, okay, how would that sort of translate? That's the way to think about that. So, and the other way to think about it too is with the deferred tax asset, or even with the salaries expense, your pre-tax financial income is going to be lower because of the higher expense, which means your income tax expense must also be lower. And so that's why we're reporting a lower income tax expense. Again, no one way to do it. There's lots of ways to think about it. But the answer is it would be 1,720. All right, notice that I have deferred tax assets and I have other assets. So this is saying all asset accounts other than deferred tax assets. What would be the restated amount? So someone asked, would a DTL increase income tax expense? Yes, it would. Yep. DTAs decrease, DTLs increase. Yep. So we have people saying no change, no change, no change. Yes. Quick momentum got you there. I think this one should be pretty easy. I hope. What should we report as deferred tax assets? Yeah, we got there pretty fast. Yeah, hopefully that's fairly obvious. I mean, if you're debiting a DTA, it's increasing the DTA by 280. Good. How about total liabilities? It's like you anticipate what I'm getting ready to say. Yeah, good job. 21,800. All right, now, again, I think you got a decent chance of getting this one. Yep. Good, good, good. Yep, 79,480. Good job. So again, even with the tax effect, I really do believe that this is the easier type of problem. So the goal, I think, is to really prepare it and ace this type of problem. And then with the journal entries, be great if you could ace that as well. But try to do your best to get close on those. Now, the only thing I'm gonna say too is that typically with this kind of problem here, I might have more variety in accounts. Maybe not a ton more, but a little bit more. Just so you're aware, like I might have a DTL or something like that, and you got to figure out, what's going on. But generally speaking, I mean, this is kind of the format of the test. Again, maybe little wrinkles here, different types of problems. Obviously, it's not going to be exactly the same as this, but this is generally going to be the flow. But good job, good job. You guys definitely did a lot better on that than the first class. Maybe it's also my second time through, so I probably did a little better job guiding you and explaining it. But any questions on this chapter 22 material? One thing I do want to point out as you prepare for chapter 23, which is statement of cash flows, there is not going to be a statement of cash flows problem where you have to upload anything. In my lecture, it was recorded this summer. And in the summer, I did have that kind of problem on the test. And pretty much it was a disaster. Not in terms of the student's ability to do well, but just the formatting and uploading and timing. It just turned out to be a complete train wreck. And so I completely reformatted the statement of cash flows problems in the fall test, and that went much better. And so instead of having one long problem, I have bits and pieces of different calculations and problems where you have to kind of just do different pieces at different times. And so that way, if you run out of time or something like that, you don't miss the whole thing, which was what happened to a lot of students, is they just didn't get it submitted in time, and then they got nothing. And so obviously I ended up having to throw the problem out, is what ended up happening. But all of that to say, for this, this problem for chapter 22, this is similar to what you're going to see. There's some more conceptual questions as well. But for chapter 23, on Thursday, we're going to do a review session, and those problems will be very similar to what we have on the test. And so you'll get a good flavor for the types of problems you're going to have. Any questions? All right, everybody. Well, thank you so much. Enjoy the sunshine, and I will see you all on Thursday. Take care. So someone asked the day of your final. There's two sessions. There's May 11th and May 13th. I believe that if you're in section 1, that you're May 11th, and if you're section 2, that you're May 13th, or whatever. I think it's 1 and 2. So it should be on your I don't know how this. It's yeah, it's on. If you look at the actual quiz, it says it out there. If you kind of click on the quiz link, it should tell you when your quiz is scheduled. Yep. Thank you, everybody. Enjoy your day.